Hey everybody, I want to welcome you to our monthly recap, but because this month ended in a quarter, we're just going to make it a Q1 recap for the markets. Today is April the 11th, 2015, all day long. I want to thank you all for tuning in. Before we get going, just a couple of quick housekeeping items. First up, disclosure: trading securities can involve high risk and loss of any potential funds invested. Any investment information provided by our user group may not be appropriate for all investors, provided without respect to individual investor financial I say this shit so often it drives me crazy. But anything, all the information here is provided without respect to just where the hell you are. Basically based on sophistication, time horizon, risk tolerance, or financial situation. It doesn't really matter to me. All the information here is presented for educational purposes only. It's not intended to be a recommendation to go out and mortgage your house and sell everything and go for any one security. But I imagine all of you have heard this so many times. You're probably tired of hearing it, and I'm tired of saying it, but I got to say it anyway. Okay, why don't we jump in? We're going to spend the next hour to hour and a half just going through Q1, taking a look at the market. Yeah, Edie, I do have bourbon in my coffee. We're going to spend about an hour and a half going through the first quarter. I want to try and go over some things with you. For those of you that are non-members on, because it's a free session for our monthly recap, it is, we always talk internationally, because if you guys probably already know by now, if you haven't, you will find out. If you're in these markets, you got to understand what's going on in the Asia Pacific area, over in the European area, over in the Latin American area, and then of course over in the Americas, to be able to make heads or tails of these markets. And you got to be able to understand where money is flowing. And that would be across the commodities, it'd be across the S&P sectors, and the major indexes around the world, because now with a click of a button, you can pretty much trade around the world globally. Some of you may have, depending on what platform you use, it's easier than others, but even with just U.S. only traders, investors, which we have a bunch here online. We got a number of folks that are in Asia right now online. We got folks from Europe online. You guys can trade in European or Asian markets or U.S. markets, and sometimes in different currencies. But it's very important that we understand this, because it also makes you a better trader if you're just sitting in the middle of the United States in Ohio or in Wisconsin or Michigan and understanding what's going on. All right, so we usually spend just a few minutes talking about the markets, and I thought Q1 would be a good time here, this Q1 briefing, just to kind of take a step back and just kind of go through some of the things that we're seeing here, okay? So, and one of the ways we do this is with sector rotation charts, performance and relative analysis graphs. And these just kind of give you a good idea of where the market has come from and the probable direction the market may go. I didn't say the direction the market will go. I'll say the most probable direction the market or markets will go, because you're never really fully certain. All you're looking to do is build an edge into your trading plan. Now, for our members, tomorrow night we're going to review one of the other trades that we've taken in our secret trader, and we're also going to go into volatility a little bit more tomorrow night. So, and just some of the things that you can do with vol continuing to fall over the past couple of weeks. So there's some interesting plays that are starting to set up. We'll talk about them tomorrow night. But for this morning's session, why don't we just go through and just take a look at where we're sitting right now. If we look at the year-to-date performance of the U.S. markets, you can see here that, you know, while these bars look high, they're really not. I mean, some markets have done very well, or some indexes, rather, have done very well through the now this is not technically through the end of March. I've run it through the end of this past Friday so that we can capture even a little bit of a better gain than normal. But NASDAQ right here is basically the number one performer, but only at 5.49%. Now, if you were to annualize that, though, that's not a bad performance. You know, that's roughly just about 20%, because we're running a little bit beyond. This includes data over the past week, but that's about a 20% annual performance, maybe a little bit more than that. The Russell right here, or the RUT, is also running neck and neck with NASDAQ. And the RUT is year-to-date about 4.99%, but around 18% annualized numbers. So these two are doing very well. Then we got the S&P right here, which is the big index in the U.S. markets. And its year-to-date is about 2.10%. And keep in mind, that's only happened, since April the 1st. So before April the 1st, or around April the 1st, we were right at flatline for the S&P. So we've only moved this amount in the past week and a half or so with the S&P markets, okay? And annualized, that's kind of around 6%, roughly, just an average rough number. So you can see here the S&P is underperforming. Now, a lot of the big investment banks and a lot of analysts had said the S&P this year would run, I've heard, anywhere from 4 to 8% annualized. So it just so happens we are running right on track with what a lot of analysts have said so far. And we've crossed the opening price for 2015 for the S&P numerous times, more than a dozen times this year, where we're in the green, we're in the red, we're in the green, we're in the red. I believe we're going to hit it again, okay? But right now, we're running a very low 2.1%. And then the Dow, the U.S., the Dow Jones is even a lower performer at 1.32% year-to-date, okay? And that's less than 4% annualized. So the big guys here are really, compared to the rest of the market, underperforming. Now, that should not come as a shock, and I will show you generally why a lot of the money that is going into the U.S. markets is not really going in to these guys here. That's not where we're seeing the money go. We're seeing the money come in over here, and I'll explain why. A lot of members, you're probably tired of hearing me say this, but at the beginning of the year, I had said, if you do invest in the U.S. markets, all right, if you do put your money in the U.S. markets, the better place to put your money is going to be, and if you don't want to trade the futures, you could do IWM, right? And you could also do MDY. I like these guys because these guys are, that's a mid-cap ETF, and that is a small-cap ETF, roughly. Or you can really take it up a notch and do a 3X ultra small cap TNA, okay? These have all done very well this year. Meanwhile, sucking down here is the other indexes, which is basically big cap, okay? And why don't we just kind of peel this back a little and look at the reasons why. Now, also, going forward, this dichotomy, I think, this relationship is going to stay like this. We may get even a wider branch out, possibly, in the MDY, in the TNA, okay, small cap. So let's go kind of look at why. And see if Blake asked the question, how does a stock get entry into the S&P versus the NASDAQ, and are any stocks in all? Yeah, you've got some stocks that are in all of them. I think Microsoft or a few others are in all of these things. And they get invited in. It's an invitation. And it's kind of a badge of honor if you go from let's say, being in a small cap to a lot of it's based on capitalization and popularity. Because remember, these indexes, they're run by companies, and they want to make money, and they want to attract trading, and they want to attract trading volume. So when Apple changed over, then that was a big thing when Apple made a move. Or and by the way, Apple, they did their split, their reverse split, 10 to 1. What was it when the Apple was at $700 and some odd a share? the Dow didn't want them. In fact, and just reading some of the articles about it, they had to do a stock split because the Dow, the way they calculate the Dow Jones averages, or the way they calculate the S&P averages, or the way they calculate some of these others, it's based on, yeah, Danny, a 7.1. So, but the way they calculate them, it's based on capitalization or on number of shares, and they do them slightly different, but it would have skewed the index if Apple didn't do their split. So that's one of the reasons why you won't see let's say a price line or some of these others that have such a huge stock price that they're not attractive to most retail traders. Big institutions can go in and buy 1,000 shares of Priceline at $1,200 or $1,300 a share, but you're not going to see Ma and Pa sitting on the back porch, with their investment money, and they're going to buy, 30 shares of Priceline. It happens, but you're not going to see it a lot. So that's kind of what causes companies to take a look at how they move from index to index, and it's not their choice. They got to be invited. But once they do, it's a good thing, right? So that's a little bit about that perspective. Also, it's the same thing with options. It used to be when a company went public, sometimes options wouldn't be available for that company for 4 or 5 months at a time. And now when companies go public, options are available almost right away, depending on the nature of the company. Some companies, there's no options at all available, and that's by design. They don't want that. So that's a little bit about how that works, but we could spend a whole hour and a half just talking about that, and that's not the purpose of today. But hopefully, Blake, that just kind of gives you an idea. Some of these events are tradable, by the way. So anyway, this is the year-to-date market performance relative. If we look at the sectors of the U.S., right, and see which ones have done well, which ones haven't, this is in comparison to the spider right there. So I drew this line on the spider, which is roughly, remember what I said, the S&P was roughly about 2.10% year-to-date, right? So that is that sector, and you can see the performance right there of the S&P or the spiders. But now look at all the sectors. Obviously, healthcare, XLV, healthcare right here, is at 8.61. It's really been leading the way. Biotech has been on fire for the past couple of years. A little bit of it is the way money and sector rotation works. You're going to see a lot of new money as it comes in, possibly going into other sectors. That's why healthcare has been a little bit weak over the past month or so. But for the year to date, it's had a really good performance. None of them are over double digits, by the way. Cyclicals, XLY. Cyclicals is a good thing. We want to see cyclicals doing very well. That shows there's not companies or investment managers are willing to take risk, okay? And cyclicals is typically when you're in a strong bear market, you want cyclicals to outperform. So, that's a good thing, right? So since cyclicals up there is good. Consumer staples. Normally, consumer staples is one of the underperformers in a bullish market. So you could probably say, but Staples is outperforming the E-minis. I mean the S&P 500. And then of course you got materials XLB, which has been just not a very good performer at all. Basically, all of these guys right here, I could probably draw a line on the chart like this. The rest of these guys over on this side here have just not been doing very well. But we've got cyclicals up here, as I said, doing very well, and healthcare doing very well. You see technology right here, XLK, doing very poorly. Energy. Now, energy has been underwater for quite some time, and it's just made a big move over the past 60 days. Energy's had a pretty good bounce. Industrials has been doing very poorly. And just recently, it's starting to come up. Financials is a concern, XLF. XLF the sector for financials has been underperforming very poorly. Now, this coming weeks, guys, we've got two key sectors that we're going to see a number of earnings. Earnings kicked off last week, and they weren't, you know, they didn't knock anybody's socks off, but most of the companies that, you know, like Alcoa led the way, and it didn't really do good. We had a strong finish on Friday with GE because they announced they were selling part of a division of their company, and it just raising billions of dollars, and they announced a huge buyback. So GE moved about 10% in one day, which is that's like an annual move for GE. So that kind of put money into the sockets of the Dow Jones because there's such a huge weighting in the Dow. But you can see here, financials is going to be one of them. XLF is going to be a lot of key financial stocks are going to be releasing their earnings next week. The other one, XLK, you're going to see some technology companies starting to release their earnings next week. These guys here must perform. When you start looking at the earnings for next week and the week after, we need to see these guys do well. If they do not do well, the markets are going to pause and then pull back. We need leadership in technology and financials. In fact, financials are doing extremely poor right now. Not hard to understand that because banks make their money on interest rate spreads between what it costs to hold money versus what it costs to lend money. And the interest rate spread is very low. Their net interest margin profit is very low. Interest rates are very low. It's just not conducive for banks and bankers. There are a few anomalies there, but we need to see finance in a healthy economy get a lot stronger than where it's going right now. And then, of course, utilities is kind of where we want it to be. Utilities has had a pretty good little sell-off year to date, and they are leading the way down. So what do we want to see here coming up in earnings? Because everybody is watching earnings, and if we have earnings are what going to make the S&P come up and take out their all-time highs, or roll them back over and go back below the zero line. All right, and I think these earnings are going to be key. We need to see leadership here in financials. If we don't get leadership in financials or better than expected earnings results, it's going to be very difficult for the market. We also need to see leadership here, XLK. So this guy right here needs to show better leadership, XLK. Cyclicals were good, or discretionary rather, were good. This guy was right where we wanted to see, right where we want to be, okay? Also, from a global perspective, we want to see industrials get a little bit stronger here. They've been weak just because of the global demand or lack thereof. Energy. Energy is going to be, on a relative performance basis, is going to be relatively weak right here, all right? That's not as important. Energy typically lags the bull market and a bear market. When a bull market is peaking and starting to roll over, energy gets then energy starts getting very strong. And then when a bear market is finishing up, then energy starts coming in. So just consider energy a lagging sector, both in bull and bear markets. And then, of course, we've got consumer staples. I don't care about consumer staples. Should consumer staples start to go up relative to these other guys, that's not a good thing, all right? But the key, next week, a lot of analysts are going to be watching the financial sector and the technology sector, all right? And they want to see leadership here. That's what they want to see, all right? And that's what's going to catapult the spiders or the S&P up or down. So just watch these. The markets, and it's crazy how the earnings cycle works. A lot of you may not understand it or just get confused by it. We've had about 6 revisions to the downside in Q1 earnings. We've had 2 or 3 revisions to the downside in the Q1 GDP number. Some people think it's going to be flat to just slightly above water. I've even seen analysts thinking that GDP could actually be a sub-zero number for Q1 of 2015. The markets have priced in a lot of these revisions to the downside because the market is a forward discounting mechanism. Now, so what's the market going to be watching for in the earnings? Not as much where we are now, but where the companies are forecasted on their go-forward projections for Q2, Q3, and Q4. Should these come in weak, you're going to see the market sell off more. So that's why sometimes you'll see earnings come out and for Q1 just report horrible numbers, horrible. But then the stock rises and you're looking and you're like, I don't understand it. And you're going to see, well, gee, their go-forward projections beat expectations. All companies need to do is beat expectations in the market. That's all they need to do. And it's fair game to keep lowering the bar so expectations are easier to step over them. And as long as they step over current expectations, then the markets will settle in and start to continue to grind higher. And you say, well, that just doesn't seem fair. Then why not just keep lowering expectations and lowering expectations until it's almost impossible not to meet them? And a lot of people feel that. But remember, expectations for an earnings cycle may be lowered 4 months ago. So some of this downdraft that we've seen in January and in March were based on these lowered expectations. And then markets sell off right away. They don't wait for the earnings to say, yeah, you were right, you hit lower. The markets sell off right away. And then companies come out, or these analysts and big money funds are talking to CFOs and others, and they look at where their forward guidance is, and they go, well, we think it may go up, so we'll put some money back in. So it's kind of a game. It's a cycle. For us, we don't have the luxury of millions of dollars to spend to do that kind of analysis. All we do is follow the money. And we look at these sector rotation charts to see where the money's going. And that tells us where the market believes the money is going to go next. So this is a very telling chart right here, okay? So again, watch technology, watch the banks. We're going to see that. If you see cyclicals starting to go down, that's not a good thing. That means risk is starting to come out of the markets. No one wants to buy jet skis. No one wants to buy big screen TVs. You know, they just don't want to do that, okay? So, but if people are buying that stuff, restaurants reporting big business, people are traveling on vacations, things like that, that's a good thing. You'll see cyclicals go back up again. So watch those earnings and try and interpret them that way. And yeah, if one is strong and one is weak, like if technology is you know, very strong, finance is weak, then you'll see money go into technology. Money will probably stay out of finance, and it just sends mixed signals, right? It's never perfectly lined up the way you would like it to be. And right now, we're in a market environment where sometimes good is bad and bad is good. We've been in and out of this what's bad news is good news for quite some time. And that really pisses off a lot of people that have been trading for a long time because it shows the power of money. And let's talk about that for a minute. We'll get into this in just 1 second in these rotations because you can see it. So let's look over here at country performance, relative year-to-date. Now, this is year-to-date. This is not annual, but it's year-to-date. Which countries have done very well? Well, Russia, RSX, is leading the way, right? But Russia was operating from such a low base. Their index, or that country index, is up 28.5%. Now, that's impossible for that to maintain that same torrid pace. But it was so low and so decimated going into the first quarter of this year that, you know, just a very small move is a big percentage on a percentage basis. China, XXI, huge. It is a bubble in the making. For those of you that are watching this, FXI's chart just looks like it's through the roof. I'll show you it in a minute. It's going to be what goes up, goes down. It reminds me of the dot-com bubble in the U.S. Right now, China is just, it's on a tear. On a tear. Why? Because China is loosening their controls and allowing folks like you and me that are Chinese citizens to invest in the markets. They're finally opening it up. It's kind of like having a store closed for weeks and weeks, or a Walmart, or before Christmas, and then finally they open up, and then, you know, there's just a crowd of people that just come flying through the door. They tear everything up. It's a mess, and then when they all leave, the store has been, you know, just sucked dry with everything on the shelves. Same thing with China. They're finally releasing the markets and letting more people come in. They're even letting foreign capital come in and invest in local currency, but you got to have $1 billion to play that game right now. But eventually it's going to provide, it's providing a lot of liquidity to the Chinese market, but only one way. Everybody wants to buy right now. And to make matters worse, China has allowed tremendous leverage. You think margin interest is high here in the United States. Typical stock interest margin or margin is usually 2 to 1, right? So for every $100 in cash you have in your account, you can buy $200 worth of stock, or 50% rather. They added 50%, or 50% margin. In China, it's 4 to 1, 5 to 1, 6 to 1. And then a lot of people margin their margins. So this sucker is going to fall, and we're going to play this to the downside. Japan, again, FXY here. They've been doing very well. And it's not a surprise that they've got stimulus going on in Japan. It's not a surprise that they've got stimulus, targeted stimulus, going on in China. And China can do it a little bit different than other free democratic countries. They just put money where they need it right away. Okay? Not a surprise that Germany, EWG, is doing very well. A lot of stimulus. And also they're helped by the currency, which we'll talk about in a minute. Not a surprise, EWI. Italy, doing very well. A low base, a lot of stimulus. People want their Ferraris. Not a surprise. France, doing very well. We've got, as a collective group, we've got a number of these doing very well. The UK, Britain, down here, they're doing very poorly right now. But I do believe there's going to be a good play in Britain. Britain is on the end of their stimulus. Britain, like the United States, here's the United States right here, the U.S., right? Why are we doing very poorly? We're coming to the end of our stimulus cycle. And our markets really haven't gone. They've gone up since 2009, 8, 9, since we've been doing our stimulus. The markets have gone up. But the economy, if you dig deep into the numbers, has not really done very well. But the market has gone up. The stock market's gone through the roof. But then on a relative basis, year to date, we're at the tail end of our stimulus. So all the money, a lot of the investment money from these countries are from the U.S. is coming into here. This is where the action is right now. These guys right here in Europe and Japan and China, because they're just printing money left and right. So it's easy to see stimulus just, it's a great way to force people into the equity markets. Money's in search of yield. When the yield is so low that you just can't get it anywhere and you're afraid of deflation, then money goes into the equity markets. Last week, history was made in Switzerland when the Swiss came out with the first 10-year government note, 10 years, for negative interest rate. That means you got to pay them to manage their money, your money. You got to pay them. So if you're a hedge fund, who the hell would do that? It's insane. That's how afraid big money is of global deflation. if in fact you go forward 2 or 3 years and there is global deflation instead of inflation, you would actually make money by putting it somewhere and paying someone to watch it. That's the only way that play works. If you look across Europe, from Italy to Portugal to Spain to Germany, they're short term on the front end of the yield curve. They're 1 year, 2 year, 3 year, up to even 5 year notes, government securities are at or below 0%. Big money doesn't want that. So what happens is that money comes into the United States for fixed income investments, which has kept the United States interest rates very low for a long period of time. And it's not a normal or normalized market when you've got all this money chasing money. And what that also does is it starts screwing up the currencies, and it creates a race to the bottom with currencies. And right now, that is what we're on. If we look at one thing here that I've talked to our members about, and it's really the only way, and what you remember earlier I said, go to IWM, go to MDY, or TNA, IWM, TNA, they kind of follow the same path. TNA is just an accelerated version of IWM. MDY, or the Qs, right? Rather than putting money in the spiders, right, or the diamonds, which would be the Dow, and I'm just talking about the major indexes now. I'm not talking about individual stocks. For those who are a little bit more conservative, like to trade the indexes. Why? Because these guys have less exposure to a strong dollar. Currencies overseas are being debased, which forces exports up because it's easier to sell with an automatic 20% discount on your products. So exports for Germany, selling cars, or Italy, or Spain or others makes it a little bit easier when you've got a very weak currency. So in the U.S., money is going into these indexes that have less overseas sales, and mostly in U.S. based, because the American consumer is spending, but not much. They're not spending much, but these guys are going to be on a relative basis outperforming. So the spider or the diamond, if you're going to invest in a major index, then you want to be an IWM, TNA, MDY guy or woman, okay? Now, let's look at over in Europe. You want to put money in Europe as well. But for those of you on the call this morning that are not in Europe or can't trade the DAX or some of the others because they're making all-time highs, a good way to do it is, as I said, EWG, right? It's a German ETF. Tracks the country. That is the strongest performing country of the countries that make up the ECB. They're just starting their stimulus, so it's logical and intuitive to invest in Germany. You can see quarter to date, it's up 11.46%. Now the growth trajectory, the growth vector is going to be reduced, but it's still going up. But a better way to invest in Germany is right here, the Wisdom Tree Germany ETF, okay? And that one, I will show you the chart, and we will look at that. You will see here that the relative performance is 24.66%, okay? Why? And it's both the same country, right? It's the same investment, but one is, you know, almost double. In fact, it is. It's double the normal one. Why is that? Well, this investment right here factors out the euro. When you buy EWG, the fund managers in EWG do not have the euro hedged out. It's almost like owning it in euros. And what's the euro doing? Well, we all know the euro is not doing that, right? The euro is doing that, which is why everybody's investing over there. But if you buy something in euros and that something goes up, but the currency you buy it in is going down, then net, you're going to go up a little bit because the strength of the country is going up, but not as much. So the ideal solution is to just invest in it in U.S. dollars and hedge the euro out, or a combination of currencies that takes the euro out. That is what this ETF is. It's relatively new, but you can invest in it, and you can see how it's doing very, very well. By the same token, if you want to invest across Europe in general, Wisdom Tree has come out with another ETF across all of Europe, and it's also doing very well. It's at 23.31%. Okay, so if you want to have a piece of Europe, and there's no reason at all why you should not, then these are the guys you want to play in. Just stay away from EWG, right? Now, if we look at Japan, you'll see there's also a hedged Japanese currency, but it's just slightly better, maybe about 10 basis points better, because the yen has not been decimated from January 1 to now. Remember, this is only a 90-day performance window here, right? It's only 90 days. So over the past 90 days, the yen has been relatively flat. But investing in these countries, you're getting a bump not only in the strength of the dollar, but you're getting a bump in that country as well. Now, by the same token, should the dollar weaken, then it's going to put a little bit of a drag on these hedged instruments, but not as much of a drag as if you were doing it in euros or yen or something else. So, and only up until about a year or so ago, you had to be a hedge fund or a very sophisticated investor that had access to the right tools to invest in foreign countries and hedge out that currency in that country you're investing in. Now it's just a click of the button. So we'll look at the chart on these, but that's where you want to be. I've been telling our members, you know, IWM, MDY, right? And the Qs is where you want to be playing. And that's the U.S. based if you want to just keep it simple, and then definitely have some exposure in Europe with some of these hedged ETFs, right? You want to do that. So that, and we're off to a good start in doing that for our big portfolios and how you want it. Even if you got a small portfolio, you can keep it relatively small and do that. Now, let's also look at the currency performance, because that is the other side of this trade. This chart right here shows where the currencies have been over the past 12 months. This is the U.S. dollar right here. Look at, and this performance is relative to the U.S. dollar. Everything is underwater here. The British pound, the futures, or FXB, is another way to trade the British pound. The Canadian dollar, or FXC, the ETF for the Canadian dollar. The Japanese yen, or FXY, for the Japanese yen. These are ETF equivalents. The Australian dollar, or FXA. And then finally, we get to the euro, which has just been totally trashed, FXE. Okay? On an annualized basis, the euro has fallen almost 24% against the U.S. dollar. And you can see the others have also fallen. And it's not a surprise that these guys are doing a lot of stimulus, all right? They're doing a lot of stimulus. The U.S. dollar and the U.S. is the only country right now talking about not more stimulus, but when are we going to start raising our rates? And there's a debate on when they're going to do it, and that's causing some near-term volatility in the markets. But essentially, FXE is the play for the currency. And a lot of people are trading the FXE against the U.S. dollar. In the Forex market, it's a very heavy trade. And there's just a ton of shorts in it, right? So that means counter trend moves go very quick. But we've been playing the euro. We've been playing the dollar. We've been playing the British pound. We have not, at least I haven't been actively, we played the yen. The big move in the yen was several years ago when Shinzo Abe was elected. We played a really good one on that one. But these currencies affect imports and exports. It affects when you debase a currency like they're doing in Europe now. That's why we want to invest in Europe. And we can do it through these ETFs with a click of a mouse. Very easy to do. We'll look at the charts in a minute. So let's go back. And you can see here, year to date, from January 2015, January 1 today, where are the relative performance of the currencies versus the dollar. You can see the yen is doing very well, or not very well, but relative to the dollar, it's almost, you know, it's almost flat. But all the others are doing very poorly. And over on the far right's the euro again, and it's just, we've had over the past 12 months, the euro has underperformed by almost 24%. Just for the past 3 months, of that 24%, half of it has been over the past 90 days. Why? Because that's when the ECB officially announced they're going to start their stimulus, and they're going to put 1.2 trillion euros into the economy, and they're going to do it every month through next September. That's their stated objective of 2016. So guys, this is a trade you want to play. I don't care what percentage of your portfolio, but you want to at least have some of that play active, and I'm showing you how to do it without having to get into the futures market or be very sophisticated. Okay, that's the play. Now, let's look at the U.S. markets and sector rotation. If we look at the U.S. markets and sector rotation, this is a rotation graph. It's a wonderful tool. You can see here the grid and the way it works. This is the best performing grid right here. The SPX is centered in the center here. So if you're performing exactly like the S&P, you would be in the center of the crosshairs here. And then as you branch out away from the crosshairs here, it's going to show, are you overperforming, underperforming, or dramatically over or underperforming the S&P 500. All right, you can see this is the number 1 grid here. The number 2 grid is right here. The number 3 grid is right here. The number 4 grid is right here. So, and the way sector rotation works, money generally flows like this in a clockwise cycle. And we can just follow the money, okay? We can follow the money. And the way this grid works, it's deceptively simple, all right? In this case, it's a 90-day rotation. Why is it 90 days? I chose each individual dot on their tail here represents 1 week in time from one to traverse 1 point on this line to another point. So each dot represents a week in time. So what it does is it shows the relative movement of sectors against the SPX on a weekly basis, and then you can follow that relative movement. Is it getting better? Is it getting worse? Or is it pretty much just caught up right in the middle here? Okay, this is a great way to see where big money is going over a period of time. XLE, if you guys remember, oil and energy markets sucked going into last year. They were underperforming in this sector down here. But you can see now they've been improving and slowly been moving up. Energy, money has been going into energy. Why? Well, I think energy, I have always said energy is going to see $40 a barrel before it sees $60 a barrel. Inventory levels are very high. You could remember when inventory came out this Wednesday, oil dropped almost $3 a barrel. It did, $3.10 a barrel. But then it's slowly working its way back up again. Money wants to go into the energy market. Okay, a lot of big money believes energy markets are way undervalued with their assets, okay? But anyway, you can see energy has done very well on a rotational, on a relative basis. Now understand, just because energy or a stock or a sector moves up here does not mean the graph on the chart looks like that. What it means is it looks like this compared to the SPX. So if the SPX has done that, then this one could have done that, and on a relative basis, it outperformed. It's all on a relative basis. But when you look at how big money managers, hedge funds, and everybody else are paid, They're not paid to make a higher percentage return. At the end of the day, if they make a higher percentage return, they make money. But they're paid to outperform the SPX and on a relative basis. So what do? They invest to outperform the SPX. That's how they're paid. And we don't really care as retail traders. All we want to do is like ticks on a dog. We want to jump on the dog and we're in for a ride. And hopefully the dog is going in the direction we want to go in. So looking at this, energy's been a good spot. That's why we like energy. Materials, XLB, you can see over the past 4 weeks it's come down, but it's starting to perform. It started down in the lower quadrant here, and it's gradually, very subtly starting to perform. All right, I like that. XLY, remember I told you, the discretionary sector, done very well. Look at technology. It's slowly, very slowly moved up. All right, and anything with a green tail means it's starting to move into the leading quadrant. So technology, and you remember the year-to-date performance, it showed technology down very low on a relative basis, right? Compared to other sectors, but it's just now starting to move up. Finance, down very low. It's in the red. This is the worst quadrant right here. It is an underperforming or a lagging quadrant, but it's slowly starting to move up. So we're getting finance and technology, and we got earnings coming out this week. So we're at a crossroads. Anywhere in this area here, you're kind of in line with the SPX. So these guys are going to start to move when the earnings hit, and we want to watch it. And don't try and predict which way it's going to go. Losers and suckers and rat brain traders try and do that. What we got to do is follow the markets, and then when the markets start to show themselves, that's when we make our play. Staples is, you remember, it was one of the best performing sectors in the first quarter, but you can see how it's starting to get into a weakening sector right now and could possibly move down here. That would be a good thing for us. We'd love to see the staples sector move into a lagging area. That means money's coming out of staples and into technology and into finance. That would be a good rotation. Healthcare. Remember, healthcare was the leading sector, and now it's weakening. It's moving into the weakening area. Why? Because there's been a lot of profit made in healthcare. We'd like to see money from healthcare go into technology, go into finance. So this week is setting up to be a really interesting week, folks, on a rotational basis. And it doesn't matter whether it makes sense or not. I keep telling everybody, it doesn't matter. Sometimes the markets just move and do what they do. You can't explain it, and we don't want to explain it. We just want to follow it and make the move. Yeah, Blake asked the question, do the lines go from blue to green to yellow to red? Well, it's really simple. When you're in the worst performing or the lagging quadrant, it's where you are right now, which is what the color of the line is. Remember, if you are now in the leading sector, the line is green, as you can see. But you can see XLU, which is utilities. It was in the leading sector here at the beginning of the year. But money came out of utilities, and it went through weakening into a lagging sector. So now this entire line is red because it's lagging. If a line is blue, that means it's in an improving sector. If a line is green, that means it's a leading sector. If a line is yellow, it means it's a weakening sector. Remember, the color of the line, if it traverses multiple quadrants, is where it is currently, not where it was. That's why you see some red in the leading sector, because that means whatever was there is now in the red, like utilities, okay? So it really is a deceptively simple chart to follow, and if you get good at following this, it will help you in where you want to start putting your money, especially if you're conservative and you just want to trade sector rotation. Let's break this down over the past 2 weeks. If we look at that same rotation over the past 2 weeks, you can see energy's very strong, right? You can see consumer staples and utilities. Utilities was way up here improving because remember we had a pullback in the markets. Whenever we get a pullback in the markets, utilities money goes there because it's kind of a risk off investment. Utilities is going in the right direction. Staples is going in the right direction. You can see XLB. That's why I think XLB will surprise people and start to move over and improve. You can see technology is in the red, right? Finance is in the red. I want to see these guys start to get better. All right. Healthcare in a weakening sector over the past 2 weeks. Money's been coming out of healthcare. I guarantee you my big sector rotation is going on from healthcare. You can see discretionary has been in a weakening area over the past 2 weeks. Transportation. Look at transportation. As energy gets stronger right here, it just follows that transportation is getting a little bit weaker. As oil and gas get a little bit more expensive, it's a natural play that transportation, just the initial reaction is going to be money comes out of the transportation sector. On a larger scheme basis, we want to see the Dow Jones transports perform well. They hit annual lows this past week and just did a little bit of a rebound. So, but again, I highly recommend you look at these charts here and just kind of follow along. Now, you can get this. This is free at stockcharts.com. Some of you may have heard of it. Some of you may have not. Stockcharts.com. This is free. But you can't do all of this analysis for free. You have to join it to do that. But just to get a free view of sectors, you can do this. You can look at a weekly sector rotation. And it's called, I believe it's called an RRG report. So you can go to stockcharts.com and just go RRG, and it'll give you this for free. So it's really nice to have as part of your arsenal, I believe, in just looking at the rotation. Now, commodities. Everybody knows, at least our members know, I've got another, we're trading a $25,000 portfolio now, very conservative, which is why we haven't done very many trades, because the market's essentially been in a chop, a wide range chop since January. We're only, out of all this movement, we're only just, a few points above where we opened in January. But futures and commodities are also been good plays for us. We're going to be starting a $100,000 portfolio here, trading portfolios shortly. And it's going to be more active in some of the markets that I also like to trade. Oil and gas, as you can see, over the past 90 days have done very good in the commodity market. That's probably part of the reason why transportation has come down. Cotton is starting to show some strength here. Nat gas had a horrible week this past couple of weeks. It's moved up a little bit, which is why I believe, remember, we're in the driving season now, so there's a seasonality to gasoline and crude oil. But as part of that's leading the way. You can see lean hogs has been underperforming. The corn market, the wheat market, the grains have been underperforming. You can see gold is starting to underperform here. Silver, which I like more than gold, is still in an improving sector here. Okay, so we follow these as well. And they're fun to play. Lean hogs, live cattle, feeder cattle. You can see just kind of how things are moving along here on a 90-day. If we break this down, and let's go in a little bit closer and just see here. Because remember, even if you don't trade futures, you can trade the ETFs that follow them. All right, and on the ETF, sugar's been decimated. We've had a nice little move recently in sugar. Lean cattle, oil obviously is in a leading sector. Gold is in a leading sector right now. You can see where we've got the ag products, we've got corn and wheat, right, just really underperforming. Soybeans starting to go back down into a lagging. So the whole grain market is being hit by oversupply and inventory. Cotton, as I said, is starting to outperform. So for those of you that are looking at these things, like to trade futures, you may do that. You can see nat gas is way underperforming. We're in the seasonal period where nat gas is weak, and oil is normally very strong. Gasoline has been underperforming. We've had a little bit of a split between gas and oil. I do believe gasoline is going to be due for a pop up a little bit, so that could be another interesting play here. Copper is underperforming. Copper is kind of known as the industrial metal, and when it underperforms, then it tends to underperform when the global economy is doing very weak. So that's kind of where we're sitting there on this rotation for this one here. But they're good to look at, because I promise you it will help you if you understand how to read these. Look at the countries here. You can see Russia, as I showed up at the top, Italy, Japan, Germany, China, Germany, Japan, China, all leading the way in the green. Spain. It's no surprise that all of these are outperforming. India is the only one that's performing with the U.S. market right here. All these others are improving or leading the U.S. market, because the U.S. market is now going out of their stimulus pattern, and all these other countries are just really getting ready to step on the gas, right? You can see over the past 2 weeks, again, the same thing. Transportation, well, it's no surprise that just about everything in transportation is sucked. It's starting to bounce back a little bit. When oil and gasoline get expensive, you can see here most of the airlines tend to kind of go together. You got JetBlue over here. Kirby is a marine transport. You can see generally the railroads tend to perform together. You can see FedEx here and UPS down here. But basically, by and large, transports as an entire sector are just really, they've been hurt over the past couple of weeks with this strong push in gasoline prices and oil. But I do believe for the markets to go higher, transports are going to have to start moving up. You're going to see marine transportation, I think, get a little bit stronger, which means countries are starting to sell more stuff and Americans are starting to buy more stuff. We'll see how that plays itself out. Industrials, GE obviously has done very well over the past 2 weeks. Honeywell, 3M, Caterpillar, Boeing. In the industrials and FedEx, I like these guys. I like, GE's had a 10% move. So I think a big part of that helium has already gone into the balloon. So there's not a lot more helium left. It could go up a little bit, but I don't see. The big move's already been made. If you weren't in GE, don't worry about it. 3M, Honeywell, Boeing, those would be, if you're into the industrial sector, those would be the ones that I would favor. Energy sector, well, what did I say? Energy, just about everything's good. Now, we're playing energy with the sector ETF, but which is XLE. But if you want to come in and start picking some winners, I love Apache, I love Phillips 66, Schlumberger, SLB is good, Halliburton is good. All of these, Hess is another very good one. All of these have been decimated over the past 6 months. And we're seeing big money starting to come in and say, well, maybe a bottom's been formed. So that's why they're all in a leading sector. They've done very well over the past few weeks. If we look at discretionary, a little bit of a mixed bag here, but Pulte Homes, Lennar, the real estate companies doing very well in the upper right quadrant, Expedia or Amazon, Coach, Wynn, Netflix. These are ones that seem to be overperforming. The ones underperforming, Nike, Starbucks, they just had a stock split. BBY, they're underperforming. Target, underperforming. So if you're looking at a discretionary play, XLY, or possibly some of these individual picks here, I like the real estate market. Interest rates are going to stay low here for a while, so I like the Pultes and Lennars. Some of the retailers, Tiffany's, Coach is doing, it's starting to perform much better. Remember, if you get into an individual stock, make sure you understand when the earnings are going to hit. Otherwise, you could get in the middle of it and just your timing can be wrong. Financial sector. Well, you can see here in the financial sector, we got some wide disparities. Goldman Sachs is the only leading one as an investment banker. Of the financial sector, The ones I like, JP Morgan, Bank of America, Wells Fargo, American Express, they're all in the red. They're all underperforming. Watch the earnings coming up over the next week or so for finance. That's going to give us a big clue not only for this sector, but the markets in general. Technology, again, it's not been leading the way. We want to see it lead the way. Apple, you can see here, is in an improving sector. Apple's had a bit of a pullback. We're going into earnings here. So I wouldn't be playing Apple before earnings unless you're doing a volatility play. Intel, Micron, EMC, Cisco, Hewlett-Packard, these have done very well. The others that have underperformed, Google, Oracle, CRM, Yahoo, Citrix, IBM. So again, I'm not playing the technology sector. Yes, SanDisk. Semiconductor just did horrible. They reduced their earnings forward guidance, and it crushed semiconductors for a while. Almost all semiconductors sold off in sympathy of SanDisk. So that is the technology side. Materials, CLF, Cliff Natural, Dow. My favorite, and a good one for you guys to play, it's fairly stable, is Sherwin-Williams. It's in the housing sector. We're coming up to the season where people want to get outside. It's been a rough winter. They're going to be painting. They're going to be doing a lot of repairing with the ice. I think Sherwin-Williams is a good one. Why? Because it's not bouncing around a lot like CLF. Sherwin-Williams kind of hangs out right here. It usually outperforms the SPX. So, and it's a $270, $280 stock. So it's a good one to sell puts underneath if you understand options. It's a good one to play. We've been in and out of Sherwin-Williams several times. I like Dow, Monsanto, Owens, Illinois. All of these, I think, in the materials sector. Remember, materials, XLB, has been horrible for a while. I think materials, you're going to see money come into materials. I know some of you are playing the materials sector, so that should be a good thing for you. So that's that one. If we come over here and we look at healthcare, again, money coming out of healthcare. You can see it here on the chart. They're all moving to the lower left-hand quadrant, lower left corner. Express Scripts, ESRX is doing good. ABBV is doing good. But Merck, United Healthcare, Humana, Eli Lilly. Now, this does not include the biotech. I need to put the biotech on here as well. Gilead, Celgene, BIIB, some of the bigger biotechs are in the lower left-hand quadrant because they've had a little bit of a sell-off here. And only because they've done so well, profits are being protected, which is, I don't think it's selling because they're bad investments. I think there's just some profit taken is all it is on healthcare. Consumer staples, well, again, the only one that's done anything is Kraft, but I would stay away from consumer staples unless the market goes bad. You can see Altria, MO, Archer Daniels, some of the more steady ones, Whole Foods. Whole Foods, I think, will be a good investment. The one that's not on here that I like the most, if you look at the chart, is doing very well, is Kroger, KR. It's a food chain, but they've just knocked the ball out of the park. All right, I've got to put them on here because they're just doing very well. Okay, utilities. Well, utilities have done well over the past 2 weeks because the market's risk is coming out of the market, and utilities have done very well. That's why they're all in a leading sector right now. But I think, and we're going to get a good play this week. I hate to keep beating a dead horse, but watch the earnings coming up this week for technology and utilities. So let's go take a look at the charts. We spent a lot of time reviewing all the sectors, all the currencies, things, and so forth and so forth. I'm going to go through these charts. If there's anything specific you want me to show, we will. So just bear with me 1 minute. And let's come over here, and we're going to start like we always do with the E-minis. And then we're going to go in and look at each of the various food groups and just kind of see how things are looking here. So if we come back over and let me get the I'm going to get the chart up for you guys here. and we look at the E-minis here, you can see here, we pretty much, this, again, I like to color my charts. The lines mean different things. The red line is the high for the year. The red line is also the low for year. You can't see it, but it's down here. 1970 was the low for 2015 for the E-minis. 21.1775 is the high. The blue line is the opening price for the year. And I think if you color code your charts like this, you'll see prices tend to react very interestingly around those key numbers. Now you can see we're moving back up. This is, again, a daily chart. So this is a pivot high right there. That's what we're going to be looking for on this daily chart, all right? So on the daily chart, the key for us is this pivot high right here. We've got a high here, a pivot high here, and you can see if I were to draw a line like that, we're at the top of this downsloping channel like that. So we've got the low, and then now we're sitting right here. So we're at a make or break this week, and I think earnings are going to take us this way, or earnings are going to take us back into the channel again. All right, there are a couple of different ways to look at this chart. It depends on whether you believe the glass is half full or half empty. One way, the way I'm looking at it, is we've just been in a very rocky range here where we're making lower pivot highs, like we've got right here, lower pivot lows. And we did not, by the way, take out that pivot low. We tested it 3 times. So that is a very valid pivot low of 2032.50. The prior pivot high here, 2107. All right, unless we take out 2107, we haven't made a new pivot high. That means we're in chop to slightly down mode. All right, that's the way I look at it. I've seen some people looking at the charts this way, where we've got a range like this, right? A very wide range, and we haven't really gone anywhere either. Yeah, you can look at it that way too. You could say we're in that, but within this range, we are clearly in that mode right now. We're making lower pivot highs, lower pivot lows. That's the definition of a trend, all right? So now, as we look at this chart here, you can see that this week is going to be very, very important for us. If we look at, now understand, right now the bias is up on the daily chart of the S&P 500. You can see the cross here, the 50 EMA, we're definitely moving up. If we look at the Russell, we're almost at all-time highs on the Russell. This is a daily chart. You can see the blue line, the opening price of the Russell for the year at 1203. We're at 1262.20 right now, so we're at 62. We're about 60 points higher than the opening price. We're coming up to the all-time high of the Russell of 1265.20 right here, and you can see the low for the year at 1139.40. So the Russell is showing more strength than the other indexes because it's a small cap generally. So that's why we like IWM. If we look at the Qs or NASDAQ, it is lagging a little bit. Let me get the NASDAQ 100, which are the 100 largest companies in NASDAQ. You can see right here, we've still got this same pattern, very similar pattern that we've got in the S&P, right? We've got a pivot high, a lower pivot high, a low, and a lower pivot low here. So unless we can clear this channel and take out that pivot high here, we're just going to come right back into the channel right here. So one other thing I want to mention for next week, it's also option expiry week. In an option expiration week, the tradition is Monday and Tuesday it kind of is weak, and then Wednesday, Thursday, and then Friday you finish strong. That is a normal week. We've got earnings coming up. So I think next week we're going to have a very interesting week. That's my belief. We're going to either break out, and if we break out, we're going to make all-time highs in the Russell and the E-minis, right? And if we look at the NASDAQ right here, and let's go to a monthly chart here so you can just see, if we go way out in time, you can see how close we are in the dot-com bubble right here on NASDAQ, March of 2000. You can see it's taken us since 2000 over a decade and a half to come back up and challenge the all-time highs, all right, at 51.32.52. That's the all-time high in the NASDAQ, the index that includes all stocks in the index. And if we break it out, you can see right there how if we take out, and this will be front page news, if we take out 51.32.52 in NASDAQ, it'll be on the Rat Brain Journal of the Day, which is the National Enquirer. It'll be markets all-time highs. We've beaten our dot-com bubble. And then typically what you can see is the next couple of weeks it'll sell off just because markets want to do that, all right? So that's where we are with the NASDAQ. Tomorrow night, guys, all of you members, we're going to spend some more time on volatility. I'm not going to do that this time around for this weekly market cap, but I do want to show you the bond market. It is an interest rate market, interest-sensitive market. You can see here bonds have been weak since the beginning of April. Bonds have been a little bit weak. We're short bonds right now. TLT, if you want to play interest rates to the upside, you go short TLT. You can see TLT now is still above the opening price of 126.29, but it's in a downward trajectory right now. All right. TBT is if you want to play in the direction of interest rates to the upside. You can see right here it's pointing to an upside movement in TBT. Currencies, we are short the euro, FXE, or the euro. You can see right here, euro currencies travel for a month or two, and then they consolidate, a month or two, and then they consolidate. You can see the consolidation patterns on here as the euro comes down. We started going short the euro for our members way back here. You can see where we are right here. We had this good counter trend move in the euro. I loved it. I said right in this area here, you want to short it, sell into rallies, FXE or the euro. So a lot of members went FXE, puts, or just buying the euro futures. And the target right now, and it hadn't completely formed yet, is down around 1.03. Parity is down here at 1.0. I think we'll hit parity before we get back up above this area here of 1.19, or let's say call it 1.15, because any up move here, it tends to be very steep because everybody is short the euro right now. It's just everybody wants to go short. So when it starts moving up, all their buy stops are triggered, which makes these counter trend rallies, the vector of the counter trend rally like this, very steep. Right? And then once all the buy stops are done, it kind of peters a little bit because no one else wants to go long at that point, and then off it goes. And that's the entry point. All right? If you haven't been short all along. Good trade, everybody. So I'm glad to see a lot of people, at least a lot of our members, hopefully you're making that play. By the same token, the dollar is just the opposite. I showed you guys the dollar moves in waves as well. You can see right here we've had this nice little pullback to the 50 EMA, and then boom, off it's going again. So the dollar is going to come back up into this area, I believe, and continue its trek. And let's just kind of see how that thing plays itself out. The British pound, we're going to want to go long the British pound. Now is not the time. It came down and hit my target. We've actually gone below. My target with the British pound was right at 1.4583. We actually hit it right here. We played, believe it or not, we played this counter trend move because it was a nice move right there. And then I said, okay, it's probably going to roll back down. I established a target right here when it was right up in that area there. And the trade of the day was to short this. FXB is the ETF equivalent of the futures. Or you could do the Forex market, but I just like going futures. So I'm not long the pound right now. Remember, over in Europe, the strongest economy in Europe right now is Britain, followed by Germany, and then all the other also-rans that make up the ECB. So Britain, they've actually started discussing raising rates, and it'll probably happen in the order of the United States first and then Great Britain second. Once they start raising rates, this guy is going to start doing that number right there. Now, it'll be volatile, but it's going to start making that move. So making a longer-term play in FXB is going to be a good move. It'll be a long-term trade. It's not ready yet. Members, I'll tell you when we're ready. We're not there yet, okay? We're not trading any of the other currencies. We have been trading silver. I happen to believe silver is going to be over the next 2 or 3 years, not over the next month or two, 90 days, but silver is going to be a good trade. Right now, it's at 1638.2. So let's look at SLV, because a lot of you don't trade the futures market, but you would trade silver SLV. So you can see here, we're having a nice little move here with silver. I'm trying to build a position in silver by selling puts underneath. Silver is not like stock. It's not going to go to zero. And remember, it can go lower. There is a point here where silver was down to 845. If silver ever gets this low, I'll be buying this stuff by the ton. I don't think it's going to get that low. I think it could pull back a little bit, and I'll just add to my position. Why? Because I believe on a relative basis, in the next 2 or 3 years, silver is going to be back up over 20. 2016 is kind of the year I'm calling for gold and silver to move. But on a relative basis, silver's cheap. So if silver moves from 16 to 20, it may not sound like a big move, but on a percentage basis and a return on capital, that's big. And if it goes from 16 to 24, 25, you know, that's a 70 or 70% move. That's huge. And it's not stock, so it's not going to go to zero and go bankrupt. So I think that's a good play longer term. Energy, oil. Oil had a good finish on Friday. We're still in this range-bound mode here, so I'm trading. I'm selling strangles in the oil market. You can trade USO right here. USO looks very similar. We're in this same mode right here with USO. You can see a lot of people think a bottom has been formed because we've had a low here and then a lower low here, but it kind of, in both instances, it's wanted to move up, right? You could say we've been in this range-bound pattern here like that, right? So you can see on this USO here, it's provided support, and then we broke, and then we've been here. For those that are a little bit more conservative, if we can break out of this pattern here, then I think it will go for a run, okay? But I think for now, we're in this pattern. We get up towards the top, we roll over. We get towards the bottom, we move up. So I think there's just a lot of shenanigans going on in the oil and gas market. I have said that oil will go lower before it goes much higher, just because the inventory level, supply and demand, it's just going to be like this for a while. Okay, there are a lot of shorts in this, which means counter trend rallies tend to move very quick. Okay, gasoline. I love gasoline to the upside. You need to have a very big portfolio to trade gasoline futures. If I blow this chart up, you can see here where gasoline finally made this big move up. The 50 EMA, it kind of hung out here, and once it blew through, the 50 EMA is providing good support for gasoline futures right now. Don't make a mistake. We're still in this little thing right here, this little downward sloping channel. Even though we're up, you could probably say this is a bull flag, a kind of a weird looking bull flag. It's just a down channel. If we break this here, we're going to make a run, and we'll come back up near the psychological 2.0 barrier for gas. All right, we're going into the driving season. Futures market tends to move in advance of the season by 60 to sometimes 90 days. So it started making the move actually in January, right? And now we're way up here. So I don't think it's going to go up much higher because there's just too much supply. Just too much supply, too much inventory. But I don't think it's going to go much lower either. So day traders are going to have fun with this guy here. Let's see, UGA is the ETF that follows gasoline, okay? So that would be the play on that one if you do not want to trade the gas market. We talked about agriculture and a few others. Let me show you here, guys. If you want to invest in Brazil, I'm sorry, not Brazil, Europe, here's Germany right here. It's a German market. you can see here the German market hung up, and we finally broke free of this resistance zone here. This is where we sit on the German market. I think it may come back a little bit, but longer term, the chart will probably look like that. It's just going to be choppy, but it's going to be a nice move up. So that's EWG. So it'd be a nice play, right? But this one is done in euros. It does not hedge out the euro. So as the euro continues to drop, this is going to put downward pressure on this trade right here, even though it's trying to move up. So the way to do it is take the euro out, like I said. How do you do that? Very simple now. With a click of a mouse, you come in and you trade DXGE. Here's the same country investment, the same area where we hung up, if you recall, but look at how further extended we are from where we were with the other one, DXGE. Now, DXGE has no options, all right? But it's not an expensive investment, $32 a share. I think this will continue to go up. It is a little bit, remember, it's done as the dollar weakens, it puts a little bit of downward pressure here. But on a longer term trade, I think this thing will go up. If you don't want to invest purely in Germany, but you want to do a general European trade, right, and you want to hedge the euro out, and this one does use options, is HEDJ. Now, I've got a trade in this one out to September in calls, and you can see here, again, we broke free, and this one is following very closely with Germany, but this is all of Europe, and we're way up in this area here. We had a good finish to the week. You can see how it's just shot straight up over the past several weeks. Towards the end of March. So while the U.S. markets are relatively flat, this thing is just going through the roof. Again, you're going to be a little volatile, but it's going to be one of these kind of moves. So you want to give it time to gel. That is a good trade right there, HEDJ. So that allows you to take advantage of some of the trade going on in Europe, some of the stimulus, which, by the way, is just starting. And that's how to make that play. All right, everybody, we've gone for about an hour and a half. I hope you enjoyed this session. I hope you walk away having seen something a little bit different, or you've learned a little bit from it. If you're not a member, you can come out and check us out. I think you'll enjoy what you see. For you members out there, we're going to have our session tomorrow night. We're going to spend some time on volatility, look at our current trade that we're running, and I'll talk a little bit about our new portfolio that we're going to be coming out with in about 4 weeks. For those of you that want a little bit more action, you're going to like the bigger portfolio. So anyway, guys, have a great remainder of the weekend. Enjoy the weather. Enjoy springtime for those of you in the Eastern Hemisphere and the Western Hemisphere. It's just now getting ready to kick off your winter time, or in Latin American markets. Have a good one, everybody. I will, John, we have some initial intro offers that you can also take advantage of. Just go to our website, click on Contact Us, and I'll make sure you get involved in some of that stuff. But we're doing well this year. I'd like to see you guys come in. So I will see you guys later. Have a great weekend, everybody. Ciao.